it had tanked nearly 15%. And as you can see on your screens right now, and the way the share price ended, very heavy pressure. What's the reason for that heavy selling? Well, founder and CEO Yashish Dahiya, there's a company statement that said he would be selling nearly 37 lakh shares. That's about a 0.8% stake. Post that, his shareholding will be locked in for a year. Before we go any further, here's my colleague Upasna telling you more about this.
Well, PB Fintech is one of the stocks that has remained in focus today, down by about 12% in today's trade and down by about 50% as compared to its listing price. Now let us have a look at what are the key factors that has led to the fall. Well, the company says that it has received an intimation from Yashish Dahiya, the chairman and CEO of the company, stating its intention to sell about 0.8% stake via a block deal. Well, the company also says that no further sale of stake has been planned for at least next 1 year. Mind you, in February 2022, Alok Bansal, the co-founder, had sold 28.5 lakh shares of the company for about 236 crores. While talking about the shareholding pattern of Yashish Dahiya, we are seeing an incremental trend. After the IPO, his shareholding stood at 3.8%, followed by 4.2% as of 31st March 2022. While his shareholding as of May 2022 stands at 5.4%. Talking about the key positives, the brokerage firm ICICI has initiated a coverage with a target price of 940 rupees. While it expects the FY26 estimated EBITDA to stand at about 10.7 billion. It is of the opinion that the company has reported a positive surprise in terms of revenue and has seen improvement in margins in Q4 FY22. It says that the profitability outlook of the company is improving. In terms of online channel, it believes it will also aid the margins and the contributions of the company.
So what does have the market so spooked? You just heard from my colleague Upasna about how much it is that the founder CEO Yashish Dahiya is selling in PB Fintech, the parent company of PolicyBazaar as well as PolicyBazaar. If you have ESOPs, why shouldn't a founder be allowed to exercise the ESOPs? Why should the markets punish the company for that? That and more is what I'm going to be discussing with Mr. K. Ganesh, who's joining us here on Startup Central. Welcome to Startup Central. You know, private markets meeting the public markets is, of course, a new phenomenon in India. But if a founder has ESOPs and has the right to exercise the ESOPs, why should the markets be spooked? Is it that the markets believe that this is the price that Yashish Dahiya of PB Fintech believes is the fair price? Could that be it?
Yeah. Hi, glad to be here. Firstly, I think this is a knee-jerk reaction. The total stake being sold by the founder is about 15% of what he holds. He still has 85% of his stake left, which has got lock-in restrictions. So I think at the first level, it's just a knee-jerk reaction. But it is understandable because these ESOPs have been granted at a very low strike price or almost face value strike price. So they are in the money at any price. The spooking happens because when the public markets shares has fallen so steeply, the founder is selling and making money when some retail investors who have purchased it in the last few months have lost money. But that's why you see this knee-jerk reaction, but just not justified. As long as the company is being run well, there is no corporate governance issues, the metrics are good, the company is doing well, the retail investor should, or any institutional investor, any investor should look at what are the fundamentals, what is the current price of the company, and where is it likely to go, rather than focusing on elements such as, is the founder selling? Now, I definitely will be concerned if the founder or investor is selling substantial, 75%, 80%, 90% of the shareholding. That means they are dumping, okay, right? Otherwise, they have been built the company over years and years, done a lot of hard work. They have given exit to all the existing investors by taking the company to IPO, by making it a liquid stock. Once you have given your early stage investor, any investors an exit, you have full right to sell. Obviously, there is some signaling, there is some sentiment there is some knee-jerk reaction, but I am not concerned at all. I don't think it justifies such a steep sudden fall just because a founder is selling small element. Yes, he is making money. Even if the company's price were to fall by further 50%, he will still be in the money because it is ESOPs, whereas other investors who have come in at last round or current price will lose money. But that is the nature of the market. I don't think we should read more into it.
The company statement also reads, K. Ganesh, and I'll quote it from here, as the ESOPs are subject to payment of taxes on exercise, in addition to the payment of capital gain tax on the sale of shares, the proceeds from the sale of the shares are proposed to be used to make the payment of current and future taxes. Is that the reason maybe that Yashish Dahiya is selling?
See, I actually don't know the reason, but the way Indian tax laws and the ESOPs are getting taxed, this is a genuine problem, because if you don't sell, you still have to have an incidence of tax. Where do you get the cash flow to pay the taxes? So pretty much in many of the cases, I don't know whether that's the case here, definitely not at this scale and size.
Fair point.
So it is normal for founders to sell stocks so that you are able to get some cash in hand so that you are able to pay taxes. Now, whether so much of 15% of his holding needed to be sold, or he could have paid the taxes to 5% of holding, I don't know the details. But keep that aside. He has run the company, he has founded the company, scaled the company, taken it public, given great return to early stage investors. If he decides to monetize and take some cash, partly to pay taxes, partly maybe to buy a holiday home or yacht, I don't think anybody should complain. As long as it's done not during the quiet period, as long as it's done not because of insider information, it's not taking advantage of it, good governance, good right disclosures, doing it, I don't think anybody should grudge the founder making money, as long as other investors have got an exit or are able to exit because it's a liquid stock.
Okay. And this is something the public markets should get used to, right? Just given the kind of IPOs that we had last year, whether it was Zomato, Nykaa, PolicyBazaar, Paytm, Car Trade, Ease My Trip. It's only a matter of time that maybe the public markets will get used to it. Is it common that we see in the West or in Hong Kong or Singapore, etc., where founders regularly sell their ESOPs like this?
Yes, it is absolutely common for founders to sell ESOPs at various points of time. There is absolutely nothing wrong. In fact, they would sell. If I were a shareholder or an involved person in the company, I would be happy that the founder is getting some monetization so that his cash needs are taken care of, so that he can focus fully on the company and work towards improving my share. Having a founder who is looking over his shoulders, his cash flow is in trouble because he is prevented from selling the shares while rest of the people are selling the shares, is not good. It's not healthy. So this is fine. But it's a very interesting comment. I don't know if you had read about it earlier. Vijay Shekhar Sharma of Paytm had made a statement, if I understood correctly, that he is going to encash his ESOPs only when the shares of Paytm reach their IPO price. I don't know if I'm recollecting it correctly or not. Now, that was a very unusual and a bold gesture. Not common, not usual, not always needed. But I was very surprised with that thing where the founder is coming voluntarily and saying that he will wait for the share price to reach a certain level before encashing his ESOPs. Okay, right. So that was unusual, and I thought that was a very nice gesture from Vijay Shekhar Sharma and Paytm to be able to say that. But again, selling 15%, not reading anything negative or anything of concern at all. Very, very commonly done to meet the either tax needs or cash flow needs. And I would rather that he does this and has a long next 10-year innings running the company than trying to leave the company and start something else so that he is able to get immediate monetization. It's good to have people who are fully motivated and who are not having a liquidity crunch in their hands running my company rather than other way around. This is not my company, but I'm just saying that.
Fair point that you're making over there. Something else that I want to ask you, Ganesh, before we let you go, and I know you have less time on your hands as well. Um, a very pertinent issue that you raised earlier was about taxation. Can you explain to the viewers of ET Now that why the current tax policy on ESOPs is not friendly for founders, employees, and now retail shareholders?
So it really rests. I mean, this is not just in India, even in other countries, this same challenge applies. Suppose I get ESOPs, say at zero value or very, very low value. When it vests, I have a certain period of time where I need to buy the shares. If I'm employed with a company, then there is no problem. But if I leave the company as an example, or I'm asked to leave, or I leave on my own, there is a very short window where I need to actually pay the price, which is very small price, and buy the shares. Now, because otherwise I will forfeit it. So now when I pay the price, it's obviously a very negligible small price. The taxman says, hey, you know what? Your last round valuation was at a very high price. So the fact that you are getting these shares at a very low price, the difference between whatever is the last round price or fair market value, which obviously is much, much higher than the low price in which my ESOPs were granted, they treat it as income and they want 33%, 35%, 40% of that difference as tax. Now, suppose I have 2 crores worth of ESOPs. I am paying 2 lakhs to exercise them. Remember, I'm just getting the shares. The company is not even listed. The company is not even public. But the taxman says, you know what? Based on last round of valuation, what you are getting for 2 lakhs is 2 crores worth. Therefore, I need 70 lakhs as an example. 70 lakhs as tax. Now, I have not got any money. I'm just getting shares in the company because I'm leaving. I'm forced to exercise. Where do I get 70 lakhs from? That is the crux and core of the problem. Taxing options or taxing vested shares which you are forced to buy before actually getting the money. See, whenever I'm able to sell the share for 2 crore, completely fair for me to be asked to pay 70 lakh of tax. Suppose what happens, I buy these shares and tomorrow the company goes down. We have seen some of these large value companies going down in valuation. Suppose it goes down, what happens? I may actually be not in the money. I end up paying 70 lakhs tax now, but the actual worth of my 2 crore shares may be 20 lakhs. So I have actually lost 50 lakhs. So there are 2 issues. One is an immediate liquidity issue because I don't have 70 lakhs to pay. I need to forward. And 2, genuinely, I may end up getting a loss in future. I may never see the 2 crore. 70 lakhs would have gone from my pocket. And this has happened in many, many, many cases. Now, this is the core challenge. Now, the solution to this is, let this be taxed when the employee makes money, when the founder makes money. When income tax should be when income is made, not when a notional income is computed based on the last round valuation. And this is something which we have been saying time and again, that this needs to get corrected. Otherwise, very, very employee unfriendly. So what happens as a result of this? When an employee leaves, even though he has got sweat equity, even though he's got ESOPs, he is forced to forfeit them because there is no way he can actually pony up the tax on it.
The final question to you, Ganesh, before I let you go. Now, this is the season of sharp markdowns, right? Whether it's a Tiger Global, SoftBank, Sequoia, the list goes on and on. That means the net worth of ESOPs is also down. That's going to be bad news for founders, bad news for employees, bad news for the startup community.
Not really, Nayantara, because the ESOPs are granted at very, very low price, at a fraction of the last round price. So ESOPs typically are always in the money. Therefore, I don't see this as a challenge. 1. 2, anyway, the ESOPs are not immediately liquid. So it is not that they were counting on this cash flow to be able to finance their house or finance their holiday home or finance the next holiday. So they were not counting on it. People don't see, ESOPs are more long-term. So from both points of view, as long as the company is not going down the tube, as long as there is a future, it will come up. So it's not that much of concern. Having said that, obviously, I'll be happy if I look at the paper money and the value is high. It's almost like your family jewelry that you have, and the gold prices are high, and you have your family jewels. You feel happy about it, even though you're not going to sell it. So somewhat similar to that, I obviously will be happy if on paper my ESOPs are worth a lot more today than what the current situation is, where it is marked down. But I do know that the ESOPs will be worth a lot more when the markets pick up. Anyway, the time of reckoning is when there is a liquidity event or a monetization event, which is further away. And my ESOPs have been granted at a very, very low price. So even at today's prices, they are still in the money. So it's not really gloom and doom for ESOP holders.
Lot to think about, and a knee-jerk reaction to the stock markets is the verdict from K. Ganesh when we look at the price action seen on PB Fintech after the founder CEO Yashish Dahiya decided to sell nearly 37 lakh shares, making up about 0.8% stake in the company. He will remain locked in for a year as far as the shareholding goes. K. Ganesh, it's always a pleasure talking to you. Thank you so much for joining us live today.